Market timing. It's a concept that has captivated investors for generations. The idea of predicting the market's next move with pinpoint accuracy is undeniably alluring. It's the dream of selling everything you own right before a major crash wipes out a significant portion of your investments, and then, with nerves of steel, buying back in at the absolute bottom just before the market begins its inevitable climb back up. It promises the best of both worlds, a tantalizing vision of investment success. The ability to sidestep devastating losses, protecting your hard-earned capital from market downturns, and simultaneously, the opportunity to capture all the upside, maximizing your gains during periods of market growth. The emotional pull is incredibly strong, fueled by the fear of missing out or losing everything. This pull becomes even more intense, especially when alarming headlines scream of impending doom, or, conversely, when euphoria paints a picture of endless prosperity. It feels incredibly proactive, almost empowering, to try and outsmart the collective wisdom of the market. But the reality, as many investors have discovered, is far more complex and significantly tougher than it appears on the surface. To succeed consistently at market timing, you're not just betting once. You must be right not once, but twice. You need to accurately predict when to sell at the absolute top and, with equal precision, know when to buy back in at the very bottom. Both of these feats are not just difficult, they're nearly, if not entirely, impossible to achieve consistently. Even seasoned professionals, armed with sophisticated tools and years of experience, struggle mightily to accurately call these critical turning points in the market. And the agony of sitting in cash, watching helplessly as the market stages a powerful rebound, can be just as psychologically damaging as enduring a painful market downturn. Each and every decision, whether to buy or sell, is fraught with intense emotion, second-guessing, and profound uncertainty. The dream of achieving perfect market timing is undeniably seductive, promising untold riches and financial security, but the actual execution, the consistent ability to predict and act accordingly, is a feat that remains elusive for the vast majority of investors. Market timing, with its promise of easy riches, is often a siren song, luring unsuspecting investors towards the rocks. And tragically, this alluring but ultimately flawed strategy has been the downfall, wrecking the portfolios of countless individuals who dared to chase the impossible dream. Investors love the idea of a crystal ball, and metrics like the Shiller-Cape ratio seem to offer one. The Cape ratio compares current prices to long-term earnings, hinting at when stocks are cheap or expensive. But using it for timing is unreliable. Expensive markets can get pricier, and cheap ones can get cheaper. If you'd sold in the 1990s when Cape looked high, you'd have missed huge gains. These metrics are better at explaining the past than predicting the future. Valuation is a blunt tool, not a precise signal. The market doesn't follow a neat schedule or correct at predictable levels. Relying on metrics like Cape is like driving by only looking in the rearview mirror. It tells you where you've been, not where you're going. Hindsight bias is a cognitive distortion that tricks us into believing past events, especially market crashes, were obvious and predictable all along. It's like looking in a rearview mirror and thinking you knew the road ahead the entire time. Looking back at historical data, the warning signs of a financial downturn often seem incredibly clear and easy to spot. We see the patterns, the anomalies, and the red flags that in retrospect should have screamed danger. But at the time when these events were unfolding, the future was anything but clear. It was murky, uncertain, and filled with conflicting signals, making it nearly impossible to predict the outcome with any degree of certainty. This bias makes us overconfident in our ability to foresee future market movements. We start to believe we possess a special insight that others lack. We become convinced that we can spot the next market bubble forming, identifying the telltale signs before anyone else does. This is because we see the last one so clearly, with all the benefit of hindsight. We forget how confusing and uncertain it felt at the time. However, every market cycle is different, with its own unique set of circumstances and contributing factors. Therefore, what worked as a strategy last time might not be effective or even relevant the next time around. Market conditions are constantly evolving. Hindsight bias encourages risky investment behavior, leading us to take on more risk than we normally would. It also fosters the illusion that market timing is a skill that can be mastered, rather than a game of chance heavily influenced by luck. We tend to remember the few individuals who successfully called a market crash or a significant downturn, highlighting their apparent foresight. but we conveniently forget about their numerous wrong predictions and failed forecasts that didn't pan out. The reality is that the future is always inherently uncertain, and no one can consistently predict market movements with perfect accuracy. No matter how clear and well-defined the past appears in hindsight, it offers limited insight into what lies ahead. Accepting this fundamental uncertainty helps us resist the urge to make impulsive decisions based on perceived patterns. It allows us to avoid the temptation to outsmart the market through speculative trading or ill-advised attempts at market timing. The best and most successful investors are those who acknowledge the limits of their knowledge and understand what they can't possibly know about the future. So, don't let hindsight bias fool you into thinking you possess the ability to consistently time the market. Focus on long-term strategies and disciplined investing. Many investors are tempted to try and time the market, focusing on dodging the worst days, attempting to sidestep potential losses and preserve their capital. This strategy seems appealing in theory, promising to protect investments from significant downturns. But they often forget the hidden cost of missing the best ones. The market's strongest upswings can be surprisingly impactful, and being on the sidelines during these periods can significantly hinder long-term investment performance. The market's biggest gains, those explosive upward movements and equally the most significant losses, often cluster together during volatile times. This creates a challenging environment for market timers, as the signals become blurred and the risk of mistiming increases. Trying to avoid downturns, a strategy that seems prudent, inevitably means you'll likely miss the explosive rebounds too. These rebounds can be swift and powerful, quickly erasing previous losses and propelling the market forward. Missing just a handful of the best days, those peak performance moments, can cut your long-term returns dramatically, eroding the potential for wealth accumulation over time. For example, missing the 10 best days over 20 years, a relatively short period in the grand scheme of investing, can slash your total return by more than half. This illustrates the profound impact that even a few missed opportunities can have on your investment outcomes. Investors who flee to cash during downturns, seeking the perceived safety of the sidelines, often miss the powerful rallies that follow, the very recoveries they were hoping to capitalize on. This can lead to a cycle of missed opportunities and diminished returns. The risk of being out of the market, of missing those crucial upswings, is often greater than the risk of staying in, weathering the temporary storms and participating in the market's long-term growth potential. The best days are unpredictable, they can occur at any time, and usually come when fear is highest, when most investors are hesitant to re-enter the market. Long-term growth requires staying invested through the turbulence, maintaining a consistent approach, and avoiding the temptation to react to short-term market fluctuations. Jumping in and out is a huge gamble, a strategy fraught with risk and uncertainty. The cost of missing out is simply too high, making a consistent, long-term investment strategy the more prudent and potentially rewarding approach. When you get a windfall, should you invest it all at once or spread it out? Dollar cost averaging feels safer, but it's often just market timing in disguise. It can ease anxiety, but the data is clear. Lump sum investing outperforms about 2/3 of the time. The market rises more often than it falls, so waiting usually means missing gains. Cash on the sidelines is a drag on performance. Dollar cost averaging is fine for peace of mind, but it's a trade-off. Lower risk, but likely lower returns. If you can handle the risk, getting your money in the market sooner is usually best. The longer you wait, the more you're likely to underperform. Understand the trade-off: emotional comfort versus higher returns. The math favors acting now. Experts who study markets and human behavior are nearly unanimous. Market timing doesn't work. Daniel Kahneman calls successful timing an illusion of skill, luck, not expertise. John Bogle warned that no bell rings to signal when to get in or out. Frequent trading and trying to outsmart the market erode returns. Even Warren Buffett admits he can't predict short-term moves. The best investors focus on buying good assets and holding them. The evidence against market timing is overwhelming. Instead, control what you can. Savings rate, asset allocation, costs, and your own behavior. That's the real path to investment success. The real secret to building wealth isn't timing the market, it's time in the market. Patience, discipline, and a long-term view win out over fear and greed. Staying invested through ups and downs is the most reliable way to reach your goals. The urge to act is strongest when uncertainty is highest, but that's when mistakes happen. The best move during market storms is often to do nothing. Build a diversified portfolio that matches your risk tolerance and stick to your plan. Downturns are normal, not a reason to abandon your strategy. Focus on what you can control and let compounding work for you. Investing is a long-term game. Let time, not timing, be your ally. The discipline to stay invested is the real edge.